Hey, we're back at work after a long weekend. The markets came today just a little bit weaker, trying to consolidate their latest advance. We're going to jump on and take a look at the charts. I'm your host, The Cowboy. This is Elliott Wave Cafe and chart of the day. Let's get started. All right, so just a quick recap. We've enjoyed a pretty nice rally last week, and I think we've gotten a pretty decent monthly close as well. We'll jump and take a look at that. And just quickly on the equities, a little bit of weakness. I mean, nothing too aggressive. I think the volatility is slowly compressing in here. We have down, about 67 basis points negative. That's where it opened. That's where it closed. So a little bit of a round trip, nothing much there. Similar story on the SP 500. Nasdaq was a little stronger, I would say, only about 40 basis points decline. Nasdaq 100 only about 30. So the technology sector was pretty strong along with discretionary today. And I'll show you this here, right? The discretionary were the, kind of up almost about 0.5%, and the materials and energy, they kind of got hit about 1.5% to the downside. And there was some news on the oil market, and that kind of took the stocks down. But I think the sector has been quite extended, and I don't think there is much more to do here on the upside. Probably a couple of more subdivisions, but I think it's on my radar for some shorting opportunities moving into the summer, into the fall. So I know this has gotten a crowded trade, and I just have a sensation about this one that is probably going to correct a little bit here. So anyway, mixed day overall. I'm taking a look at the VIX. That was, trying to climb as the markets open, maybe up to 28, 25, and then back down towards 26. Try to stabilize in here. I'll show you the VIX charts here in a second as well. So mixed market. I think, it's a short week, this one as well. It's the beginning of the month. A lot of, I think the flows already happened at the end of the last week, and the markets are just trying to kind of reposition here for the summer. But to tell you the truth, I think we're going to go into a period of low volatility, maybe more chop. I think the big swings in the market have already happened, until we're probably going to get into the fall, we're not going to see a whole lot of action, of super action. I mean, the markets kind of got us used with a lot of volatility, 3-4% up and down, and this jump, between highs and lows, consistent here. That's kind of gotten me tired here over the past 3 months. I think this is going to slow down. So let's jump over and take a look. So bonds were, they sold off. I mean, you see here yields going a little bit higher on the 10-year. We've gone back to, 2.84. I think 2.88 was the high of the day. So a little bit of a climb here and yields dollar was pretty much flat, not much happening in there. I'm continuing to be, I think, a seller of rallies on the dollar. I think the dollar found a pretty important top and is going to continue to weaken overall. That's my view on the dollar. And on the yields, I think they're going to continue to retreat. So I'm going to look for opportunities to buy bonds, maybe TLT and some other interesting ones. All right, let's see. Let's jump over to the charts and take a look. We're going to start with the S&P 500, and I'll have a look also at the counts. I just want to give you a quick rundown on what's happening on the daily chart. So here is the S&P 500 on the daily. Big corrective move in here. I think this is possibly a large ABC or maybe a double zigzag in here, although this leg looks quite impulsive. On its own, we were able to climb above the 21, climb and close above the 21-day moving average. And I think that's an important signal. We've been talking on this channel for the past 2-3 weeks in here, waiting for a little bit of a relief rally. All those indicators were screaming and signaling to us that we're reaching extreme levels. That at least a 10 to 15%, maybe 20% rally will come. I think we've gotten 10% of the lows. I'm looking for a little bit more into the summer. But I'm going to take this for now up here into this resistance. So maybe a little bit of a pullback remains to be seen, but nice to see that this market has been pushing higher here on pretty decent volume as well. So look here at the weekly time frames, nice bullish engulfing. The last week was one of the strongest weeks we've had in a while since this decline. Is it a counter trend rally? Could very well be. We're back near the 10-week moving average. So you see up here, right? We're getting close to that 50-day. That's the kind of the intermediate trend in here that we have to pay attention. As long as we stay below that, the markets can still trade with a negative tone. So just because we've overtaken the 20, doesn't mean that we're going to go to new all-time highs. There is still a lot more work to be done. But if this move gets impulsive, then we can buy three-wave pullbacks against that impulse. Here is the 200-week, a little bit lower at about 3,500, 3,493. Nice, decent rally in here. We would want to see an additional week of strength. The last thing I would want is a break back below this 3,900. I think that's going to be considered a big failure, and then you can actually move lower. So let's see what happens this week and kind of how it closed. The last thing you want in terms of price action, it's a bearish engulfing candle, because that means an upside failure and you're going to get more downside. So that's kind of how I'm reading these markets. On the monthly, which we have closed today, we created a little bit of a doji candle in here. I don't think if I'm super confident necessarily in it. I would have liked it to be more of a hammer. I've seen plenty of instances where you create a doji and then there's another black candle following right after that. But this is going to be in the month of June. We have the Federal Reserve coming up, so maybe we'll have a little bit of a bounce around. But basically, we close where we open, right? We opened, we went higher, we went lower, and then we closed pretty much the month where we opened. Pretty much a flat month overall. But I wouldn't call it necessarily a bearish close. I think this is so far a positive sign. It would have been bad if this month would have been black as well, because then that would have hinted that you're probably going to go back towards 3,200, maybe 3,000 into the SP 500. Here is the longer term moving average here. That's probably going to be supportive of prices in case of any further downside. Take a look at what happens on the put-call ratio on the S&P 500. I've talked about this a few times. This is a moving average. It's a 5-day moving average of the put-call ratio. The kind of the black, the gray lines here are the regular movements in the ratio, right? The ups and downs, and this kind of creates a bit of an average just to kind of smooth out the noise. You're looking at a bit of a nice resistance line back in there. I talked about this heavy level of put buying. You've had some of the biggest put buying exactly when the markets were hitting toward 3,900, 3,800. I mean, come on. It's why would you protect yourself on a market that's already screaming extreme levels, extreme ratios? But you can't. This is a human nature. It happens repeatedly over and over again. People will get extremely bearish exactly at the lows. They'll get extremely bullish extremely at the highs, and markets will snap back. And there is no better indicator than that, than what you're seeing in here. Every time you've gotten big spikes like this, the markets reacted from there. And this is not the only one. I mean, there's plenty of them: advanced declines, new highs, new lows, all sorts of breadth indicators, percentage of stocks above 50, above 200, things of that nature. They were telling us, listen, be careful here, because the market might take the other side of your bet if you're buying puts. So it doesn't mean that you don't need to buy protection. Maybe if you want to buy protection, wait for the VIX to come lower, wait for this put-call ratio to decline, and then you start buying puts, because this market will rally, and then that will give you protection to the downside in case this is a fake counter-trend rally or a bull trap, how people kind of call it. So here we are with a nice increase here, about 41.32, put-call ratio coming down towards more normal levels. I would let it, let's say, come back down a little bit more before I would get excited about more downside in any way, shape, or form. Here are the new highs, right? We've talked about this last week as well. As this indicator was continuing to make lower, higher lows in here, right? You would see as the price was coming down, this was telling you underneath the surface that, you're going to get a bigger rally coming up. And here we are on the advanced declines, on the new highs, new lows in here, climbing pretty nicely in here. I mean, we're nowhere near, some of the high levels that we've had during the bull market, right? So I'm not going to just completely say, fine, we're out of the woods in here. But I think a big chunk of the move, has been already kind of made. And it just kind of made a point that this, when you have extremes in price like this, it pays to pay attention to the other side. Now, the move has already happened. It's very tough now to start to get bullish right now, right? It's now you got to be cautious. You got to wait a little bit to see how much more you're going to go. Maybe wait for a pullback and then get bullish again. But, you know, a big chunk of the move has already been made. This indicator already has been satisfied as it kind of breaks to the upside. But again, if you look at it, these are shorter periods where you're going to get these extremes. Most of the times you're getting green. Most of the times markets like to be bullish. I don't know why. They take the stairs up, the elevator down, quick flush, you know, get everybody out and then rally again. So that's kind of where we are. And also pay attention to the VIX of VIX. This is the volatility of the VIX, basically, how much strength it's in the VIX index, in the fear gauge index here. And you can see, you know, we've gone up to 36. We started to kind of come back down. This move in here, this never confirmed the fact that there's fear in the market. The VIX was telling you that there is a, you know, there's a divergence there. VIX was coming lower. The stocks were pushing lower as well, and they were supposed to work opposite of each other. So that was an interesting, another signal that told us, listen, there's probably going to be a rally in here. Just be careful. Volatility of the VIX was starting to come down. What does this mean? This means that you're pushing into a different regime now, right? This is a higher volatility right back in there. Okay, that means that you have pretty much an elevated VIX above 20, above 25, right? This is levels where the swings in stocks are higher and lower, and you have bigger ranges, you have bigger moves in the market. The moment the volatility of VIX gets down, that tells you that the fear is starting to subside, the moves are going to be lower, and you're probably going to go into some kind of a summer doldrum in here where you're not going to get a lot of excitement from the market. And when VIX does this, right, I mean, you're back at 93.10 on the VIX of VIX, right? And then when you're moving into periods like this, you're coming into a different regime here, right? Just a little bit lower back in there. That means more of a, uptrending market, maybe a triangle, something that's not that crazy. So that's what you watch. If you see this thing spiking higher, right, then you know that's a big sell-off, right? Then you see VIX getting about 37, 40, those are pretty much large crashes. So that's a very good gauge to kind of keep an eye on, and as it gives a little bit of a read into what's going to happen in the future. Remember, we always, as traders, we have this kind of recency bias when we think what happened is going to continue to happen, right? And all of a sudden, we're ready to kind of trade and move up and down, and then all of a sudden the moves start to die slowly down, and you're like, what the hell is going on? I'm losing on my puts, I'm losing on my calls, I'm not getting big returns on these moves. I mean, the market used me, the market got used, I got used to the market moving into kind of high percentage ranges, and all of a sudden, things are kind of slowing down, and what that tells you is that you have to deploy different strategies onto trading this market, right? You might want to move to different option strategies, butterflies, you got to do iron condors, you got to do, different things, not necessarily just kind of continue to sell premium. And so you just have to take advantage of a different regime in the market, okay? So anyway, I talked about this because I think it's important. I've mentioned some of this stuff also in the pro video that we've done this morning. I've done a video for our Bitcoin room as well. Bitcoin has been having some interesting moves as well. In there, we'll see kind of what's going on the crypto land, but a bunch of those coins, I think they're coming into some strong support. They're starting to show signs of stabilization. We're moving above 20-day moving average. I mean, I've counted only today, I think about 25 or 30 coins that are above their 21. I've opened another channel for just for altcoins, where I'm doing daily videos and coverage of major coins, for our members, just focus on altcoins, because I think we're coming towards the end of this move, and we're probably going to start enjoying a little bit of upside. Maybe not just yet, but things are starting to stabilize and start to look fairly decent in terms of counts as well. We have a channel for where we follow only Bitcoin and videos and comments and take a look at all the counts in there, and then we have the main one where we discuss this type of markets, where we look at macro, oil, natural gas, SP500, Nasdaq stocks, sectors, things like that kind of, give traders a view of how to approach the market, where the opportunities are, what's going on with the VIX, what's going on with the, because these markets are all kind of related. So I wanted to just make a pause on that. By the way, this is the last day of, I'm going to put a little plug here, but this is the last day. Actually, there's not that many hours, maybe about 8 hours, 7 hours of, you can get access to my room. For the price of 1 month, you can get 2 months and see how you like it. Hey, if you hate it and you say, you know, Chris, you're good for nothing here, you know, you can just be on your way. But, you know, give us a try. You might just get hooked, I'm telling you. So, all right, let me just jump over and take a look at the counts. So I'm going to open up this platform, the Motive Wave. So here is the S&P 500 in a decline that you know, this ADC, you know, looks interesting. I think it's fine. I'm gonna kind of continue to kind of go with this for now. You know, pretty decent wave structure, equality between wave C and wave A. Maybe the C wave a little bit bigger. It does look nice and impulsive. You can go here, right? You can have a wave 1, 2, 1, 2, 3, 4, and 5, 4, and 5. So I think you have, you know, a pretty decent 5-wave decline in this wave C. Combine this with a bunch of those oversold indicators. You know, this was kind of screaming a move back up higher. One of the targets that we've had in the program was this kind of 4150, 4200 for a rally. I was expecting it though to begin a little bit sooner. You know, the market dropped lower one more time, which is fine, but it doesn't change the fact that, you know, this rally was kind of long in the tooth and it was supposed to start to show up. Now I'm looking at this count maybe as a 1, 2, 3, 4, and 5. Maybe there's another 4th wave forming right now with another push higher. That I think would finish the wave A of the lows. Then maybe we're going to get a B wave in here and then a wave C rally like that. That could possibly finish either an X wave, or if this wave extends higher, right, then you're getting in a 1, 2, 3, and you can move to new all-time highs. And then this rally here could be the end of it, right? This just could be just an ABC pullback for a second wave, and then you're ready to move to new all-time highs. So it all depends in kind of how you rally from these levels, you know, kind of how strong you're going to be pushing. But the fact that you've rallied impulsively from these lows to these highs, that's encouraging, and that kind of tells you that this is not the end of the move. This is just the beginning, and you're going to get this impulse, you're going to get a correction, and then at least one more impulse higher. And how this unfolds will tell you what the next sequence is. Okay, so we're going to be watching this trend line. We're going to be watching the way this B wave could be a lot of things, right? It could be a flat, it could be a triangle, it could be, you know, a zigzag, whatever it wants to be. This B wave could be very messy. It could come a little bit lower in here. So this will maybe feel like you're ready to push back into a bear market. Many times, after you have the first advance of the lows from a market that's pretty bearish, when these are going to start happening like this, a lot of people are going to start screaming, oh my goodness, see, I can't believe this, you know, here, I'm buying this market and this market is going lower again and it's going to, you know, take all my money and all the stocks are going to sell off, and you're going to hear CNBC and Jim Cramer and screaming and this and that and the other, and it's just going to be a B wave. You know, and you're going to get a B wave, and that can be 50%, 61%. Rarely you're probably going to go all the way back to 70 on a B wave. Usually that's a wave 2 that kind of travels deep, and it could be a wave 2. If this is the beginning of a larger bull market of an impulse higher, this could be a 1, 2. You know, and you can get a wave B all the way back here, 3,900. You know, below that, I would be, you know, kind of worried that these things could probably push lower. You know, but again, this depends how this unfolds. Right? If it's a 3-wave move, it's a 5-wave move. It's all these signs that the market is giving us ahead of time to kind of start to read into those patterns. And then we'll see kind of what happens to the upside. Here are the moving averages. So you're looking at, you know, the 21-day right in there. I talked about this previously, right? So the 50-day is just above it, about 42.73. So if you look at this, these moves, you know, let me just go on the daily, and I'm going to make this a little bit smaller. But when I look at this, you've been above the 20-day moving average for, you know, a year and a half almost, right? Right here from the middle of 2020, let's say July, you climbed back above the 20-day moving average and you went all the way up here to the beginning of this year. Then you begin the sell-off and you're below the 20-day moving average just for a little bit of time. Will we have enough power to climb back above it to regain the uptrend? You know, maybe this correction is too short. That's why I always like to think and look at this. If this is a second wave of some sort, this thing could still be fairly small. Maybe this can extend a little bit like that. Give it more proportion, which means that you might get an X wave in here and then another decline. If it's done and if it's over, you know, so be it. That means that, you know, this market will show us once it breaks above those levels, you know, and you start to take that swing high right there. It's very important for me that 4,600, if we start to climb back above there, we're probably going to go to new all-time highs. pretty fast, and that correction would be over, and you could, begin a much stronger kind of move to the upside. But again, we're just beginning quantity tightening. The Fed is still gonna increase rates at least for 2 meetings in June and July. Then we'll see what happens in September. The data in the economic data is still kind of slowing down a little bit in here. So there's still a mixed bag. And that's why I think that maybe for the rest of the summer will be, kind of climbing and coming back a little bit and then pushing back higher and then do a little bit of a mess until, we're getting in September, and then see when we're going to begin the next leg lower, or we're going to continue to push. So that's all I have for you guys for today. Don't forget to subscribe and like, visit me in the pro room, take advantage of this promotion. It's going to finish up here in a few hours, and come and say bye. There's also a public channel. I'll be happy to hear from you. Show me your charts, your thoughts, whatever you think. Leave your comments below, and I will see you tomorrow. Bye-bye.